How's everybody doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to take a look in on what's going on with Europe, what's happening with some of the European banks, what's happening with some of the banks in the UK. I haven't really done a whole lot of reporting here on the channel in terms of overseas or, what's going on in the Asian market or India or anything like that. So I figured I saw some articles the last couple weeks on what some of the European banks were doing. I figured I'd try to report on that a little bit. So let's bring in here. I've got a couple different articles here today. So the first one is UK banks expected to hike loan loss provisions in the coming years. So the UK's biggest banks are expected to see loan loss provisions increase in the coming years as asset quality normalizes from historically low levels. So provisions at HSBC Holdings, Barclays, NatWest Group, and Lloyds Banking Group are set to increase on a year-over-year basis in 2025 and again in 2026, according to mean analyst estimates compiled by S&P Global Market Intelligence. And then we can see here in the chart that the projected increase in loan loss provisions. Barclays, I don't think anybody looks to be increasing the provisions tremendously over where they're currently at. It's just kind of looks like a little bit, definitely an uptick, but just a little bit of an uptick, not like this kind of massive increase. Asset quality deteriorated somewhat in the first quarter. Model-led reductions in provisions and releases from post-model adjustments stocks kept impairment rates low, but non-performance continued to tick slowly upward in UK banks' loan books. However, the rating agency pointed out that underlying asset quality appears to be converging to where the banks themselves expect it to be, which itself is below the long-term average for most of them. Let's see down here. Anything interesting? So big four UK banks impairment charges reversals. So let's see here. So the big one that sticks out here, I think, is in Lloyd's. Obviously, you could see a major reversal there from Lloyd's as we look at this graph here. Let's see here. Lloyd's booked an impairment reversal in the fourth quarter of 2023, mainly driven by a significant write-back coming from the future repayment of debt from a single name client, the bank said. Lloyd's $57 million impairment charge posted for the first quarter of 2024 equals a loan loss rate of only 6 basis points of average loans, the bank said on April 24th. The bank reiterated its full-year guidance for a loan loss rate of less than 30 basis points and updated its expected credit loss models in the first quarter to reflect improved economic growth expectations. So again, kind of interesting there. So in other words, over in the UK, a lot of these banks are basically expecting to increase their loan loss provisions, but only because they're expecting asset quality to normalize, not deteriorate, not get worse, but just normalize back to kind of a normal delinquency level. I find that a little interesting because I think that it's more going to deteriorate than it is going to normalize. But anyway, we'll see there. So let's continue on here. See what else we got. So investors expect a surge in bad commercial real estate loans at European banks. So as we go down here, so bad commercial real estate loans at European banks are set to surge in coming quarters, according to buyers of distressed property debt. Yes, that is basically the sentiment that I was just trying to echo. The recent sharp rise in interest rates has made debt repayments unsustainable for many borrowers, creating widespread stress across the sector, several property executives told the DD Talks non-performing loans conference in Barcelona, Spain on May 16th. The office market specifically is where we see a lot of stress coming, said Josh Silver, director at Malta-based alternative investment manager, A Partners Capital. Secondary concerns: lower office occupancy followed the COVID-19 pandemic is exacerbating the impact of higher interest rates for many office landlords. In particular, The slump in demand for secondary offices, older buildings, and peripheral locations is pushing rents down in many areas, making repaying debt at higher rates even more difficult for landlords. The banks don't know what they're going to do with these loans at the moment, Silver said. That's an area where we see a tremendous supply coming. They do know. It's called extend and pretend and pray that the rates come down. Let's see here. Going down here, there's kind of like this north-south divide. German, Austrian, and Nordic banks have attracted negative attention in recent quarters for their exposure to commercial real estate. I'm going to get into that in just a second. At 20%, German banks' commercial real estate exposure as a proportion of total loans is already in the upper range of European economies, without including the country's savings and cooperative banks, which account for 30% of its banking sector, according to a May 13th report from credit rating agency Scope. The recent strong economic performance of Southern European economies compared to previous cycles has cooled prospects for buyers of bad real estate debt in the region, which was Europe's biggest source of NPLs in the last decade. It means there are less distressed opportunities in Southern Europe, or they're more complicated and they're not as obvious as before. The direction of interest rates will largely determine if European banks will be forced to offload significant volumes of commercial property, NPLs, in the coming years. Everyone is hoping, betting that rates will come down. What did I just say? Which would bail property investors out on two fronts: one on the cost of debt repayments, and the other on the valuation of the asset. The extent to which banks are willing to be patient with distressed commercial borrowers will also be key. And then we have like damage and distress. So the end of this cycle will depend a lot on how banks react to it. If a lot of commercial property gets repossessed, where people are forced to sell, then we'll see a very damaged and distressed market pretty fast. Getting burnt. I don't expect to see banks coming back. Commercial real estate lending is difficult for them from a regulatory perspective, or if they get burnt a couple of times. So I don't think that's the market that will be growing for us. Banks also struggle to attract and retain the expertise needed to manage their business with the sector optimally. The constraint that we've seen is probably not so much a lack of appetite, but there's actually a lack of manpower in the banks. Banks may have balance sheet, but they don't necessarily have enough people on the underwriting side. That's kind of an interesting comment for some of these European banks here. So now Germany. So the investors over there are basically saying that they are expecting this surge in commercial real estate delinquency. However, there's kind of this north-south divide where, Germany, Austrian, Nordic, some of the Nordic banks are basically they're saying, okay, those could be the problem child. And that the southern banks, like, Italy, Greece, like places like that, seem to be okay, or an okay spot. So the question becomes, why would they be concerned about German banks? And I give you, pow, German specialist lenders move to curtail U.S. commercial real estate risks in the first quarter. So German specialist lenders, Ariel Bank AG and Deutsche PF and Briefbank, took steps to lower risks in their U.S. office property books in the first quarter of 2024 as market conditions remained tough. The banks, which have high exposure to U.S. commercial real estate and office properties in particular, face rising credit losses and falling profits in 2023 as market prices and transaction volumes collapsed. Since then, the banks have been focused on limiting non-performing loans and business in the U.S. office market, with both announcing further reductions for the first 3 months of 2024. As of March 31st, the U.S. accounted for the largest share of each bank's total property NPLs, and office property NPLs accounted for over half of their bad loans, company filings show. So now let's take a look at a couple of the charts here so you can see, look at that. U.S. accounted for 67% of the delinquency for Ariel Bank. Office, 59% by property type. So U.S. office, huge problem. And then PBB for the region, U.S. 41% property type, 53% office. So the U.S. office market remains very challenging, and we are monitoring developments closely, Ariel Bank CEO said during a May 15th earnings presentation, adding that the bank has chosen not to enter any new U.S. office loans in the first quarter. Ariel Bank reduced NPLs in its structured property portfolio by over 500 million to some 1.1 billion, the bulk of which was U.S. office. First quarter credit costs to pre-provision profit levels improved materially at both banks compared to the previous 3 months, but remained elevated compared to a year ago. So pre-provisions, profit, loan loss reserves, anyone? So, okay. All right. And then let's see, going down here, Ariel Banks, problem loans, the share loans. Yeah, kind of going up there. ATI bond prices down and then back up. So, okay, so there you have it. So this is why, and then I have one last article here, and this was going back to Monday, February 19th. So German bank stocks fall, fearing losses on loans from commercial real estate. So German bank stocks are falling. Brief Bank, a mid-sized German fund specialized in commercial real estate, sank 40% lower at the end of the previous week than at the end of 2023 as the turmoil over the large losses of New York Community Bank Corp., a U.S. regional bank, continues. The market is skeptical about additional related losses. And then, it goes on to talk about a few of the indicators and stuff like that. So the reason why a lot of these German banks are having issues right now is because a huge part of their portfolio is in U.S. office properties. There's a couple people on X, Twitter, that I follow, commercial real estate people, that basically they've posted up, this building just traded for this office building traded for that, and monitoring a number of office markets across the United States, particularly your major urban areas, Chicago, New York, Washington, D.C., Baltimore, Philly, out in Los Angeles, San Francisco, Sacramento, San Diego, those kind of places, and basically just saying how, these properties, some of these properties have gone for next to nothing, and you might be sitting there going, well, how could these properties be getting dumped? But we're not seeing that with U.S. banks. That's because it wasn't U.S. banks that lent the money. It was European banks. It was banks in Germany. It was banks in the U.K. that had lent this money. So I think, like I said, so I just thought that these were some very interesting articles. So you've got, banks in the UK increasing their loan loss provisions because they think that loan credit quality is going to normalize when, I would say deteriorate is a better word. You've got this whole issue with the European banks. German banks are getting hammered right now because of the amount of exposure that they have in the U.S. market, but you also have this divide between North and South. So again, very interesting. I think things just to note, do I see, things in Europe falling apart or looking as bad as they did a decade ago when you had all of the huge amount of bad debt in places like Spain and Portugal and Italy and Greece? No, I don't think that's particularly on the horizon right this second, but we still need to keep an eye on all this stuff. I will try to report more on this stuff, especially if anything comes up or if, new things come about. I'll be sure to bring that back to everybody and let everybody know. But again, hopefully people found this interesting just to get a little bit more perspective on kind of what's happening with our neighbors across the ocean. So I'll wrap up with this. If you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to check us out at thebankernextdoor.com. Remember that we are on YouTube, Rumble, and all major podcast platforms. Please check out some of the other videos that I've posted up, and I hope to see everybody again real soon. Thanks a lot.